Welcome to TalkTickers. We dive into earnings calls to pull out the insights you, as experienced investors, need.
Right.
Today, we're unpacking the Q1 2025 call from CVB Financial Corp, trying to understand what really happened behind the numbers.
Yeah, CVB Financial, they reported what looks like a pretty stable first quarter. GAAP net earnings came in at $51.1 million.
Which translates to 36 cents per share.
Exactly. And, the really standout number is their streak. This makes it 192 consecutive profitable quarters.
Wow, 192. That's 48 years of consistent profit. Really speaks volumes.
It absolutely does. It's quite a track record.
So beyond that headline number, what were the key financial movements that caught your eye this quarter?
Well, one significant point was the net interest margin. It actually expanded to 3.31%.
Okay, 3.31%, up from what?
Up from 3.18% last quarter, so that's a 13 basis point jump. Pretty notable in this environment.
Yeah, definitely. An expanding margin is often a good sign. How did the core business lines look, loans and deposits?
Well, it was a bit of a mixed picture there. Total loans actually decreased. They ended the quarter at $8.36 billion.
Down from Q4 then?
Yeah, down from about $8.53 billion at the end of last year, and also down year over year.
Any particular reason for that drop?
A big chunk of it, $168 million, was a decline in their dairy and livestock loans. They mentioned part of that, about $40 million, was linked to final distributions from the Fairlife sale.
Okay, so it's a specific factor driving that segment. What about other loan types?
Commercial real estate loans also saw a slight decrease compared to the end of 2024.
Right.
But on the flip side, commercial and industrial loans, C&I, they saw some modest growth.
Interesting. You mentioned the dairy loans. Any color on the activity there?
Yeah, they noted the utilization rate in that dairy and livestock portfolio was, well, pretty low, actually, just 64% at quarter end.
Okay, so loans down. What about the other side, the deposits? Did they follow suit?
No, actually the opposite. Total deposits grew. They hit $12.3 billion.
So growth there.
How much? Up about $56 million from the previous quarter and $95 million higher than Q1 last year.
And the quality of those deposits? Any shift in non-interest bearing?
That was another positive point, actually. Non-interest bearing deposits grew by 2% compared to the end of 2024. On average, they made up 59% of total deposits during Q1.
59%. That's a very strong, low-cost funding base.
Absolutely. Very sticky money.
Anything else from the highlights before we dig deeper? Capital allocation?
They kept up their share repurchase program, bought back about 782,000 shares in Q1 itself.
At what price?
Average was $19.53, and then they bought back even more in April, another 1.3 million shares at an average of 17.26 cents. So 2.05 million shares repurchased year to date.
Shows continued confidence from management in the stock's value, I suppose.
Seems that way. One more thing on loans. Actually, originations. They mentioned Q1 originations were up about 13% compared to Q1 of 2024.
Okay, that's a positive sign looking for. Let's maybe circle back to that profitability then. 192 quarters, 142 consecutive cash dividends paid out too, right?
That's right. And they declared another one for Q1, $0.20 per share. Their return metrics were solid too. Return on average tangible common equity was 14.51%.
And ROA.
Return on average assets came in at 1.37%. Pretty healthy numbers.
So let's unpack that net interest margin expansion again. You said 13 basis points. What was the main driver?
Management pointed mainly to balance sheet deleveraging, specifically reducing borrowings and other wholesale funds towards the end of last year.
Right, paying down higher cost liabilities.
Exactly, lowering interest expense that way. If you compare, Q4 2024 was 3.18% and Q1 2024 was 3.10%. So you can really see that upward trend recently.
Makes sense. Now, on the loan side, the contraction. We mentioned the dairy impact. What about the year-over-year picture for commercial real estate and construction?
Yeah, both of those categories were down compared to Q1 last year. Commercial real estate and construction definitely saw declines over the 12-month period.
But you mentioned that uptick in originations, 13% higher than Q1 24.
Correct. And those new loans came on at an average yield of 6.5%. Plus, they highlighted April specifically said loan closings in April were the highest single month figure they'd seen in 14 months.
So maybe a turning point there. Could suggest loan growth might resume.
That seems to be what management is suggesting, a potential shift towards renewed growth momentum.
Okay, let's switch to deposits again. The growth is good, but what about the cost? How's that trending?
Actually, the cost of funds came down. The total cost of deposits and repos decreased to 0.87% in Q1.
Down from
0.97% in Q4. And the cost of non-maturity deposits also ticked down.
And where are these new deposits coming from?
They emphasize strong pipelines, especially focused on operating companies. And their specialty banking group seems to be doing well. That's areas like title escrow, property management, fiduciaries.
Those tend to be pretty stable relationship-based deposits.
Exactly. They also mention the typical seasonal patterns, expecting a buildup post-April tax season.
Right. Let's talk asset quality. Any red flags there, or was it generally positive?
Generally positive, I'd say. Non-performing loans and delinquent loans both decreased significantly.
Good, Pierre.
Yeah, and they also managed to offload some OREO assets, other real estate owned, sold $19.3 million worth.
At a gain or loss?
Actually generated a net gain of $2.2 million on those sales. Plus, they had net recoveries of $130,000 for the quarter, so they actually recovered more than they charged off.
Impressive. Any areas of concern, though?
Well, classified loans did tick up slightly. They said that was primarily due to downgrading loans related to a single dairy relationship.
Okay, so specific to one borrower.
Seems so. And they were quick to point out that overall credit metrics for the whole dairy and livestock portfolio actually improved despite that one downgrade.
Got it. And how are they provisioning for potential future issues? What's the allowance looking like?
The allowance for credit losses, or ACL, held steady at 0.94% of gross loans.
And the provision expense?
They actually recorded a $2 million recapture provision for credit losses this quarter.
A recapture, so they release reserves?
Yes, for the loan portfolio. But they did add about $500,000 to their reserves for off-balance sheet commitments.
What kind of economic forecast are they using for these calculations?
They mentioned using Moody's scenarios. The baseline anticipates slower real GDP growth ahead, a rising unemployment rate, and importantly for a bank like CVB, continued declines in commercial real estate prices.
So a relatively cautious outlook baked into their reserve levels.
Seems that way, yes.
We mentioned the buybacks earlier. How does that fit into their overall capital picture?
Their capital levels are very strong. The tangible common equity ratio increased to 10%.
10% TCE is quite robust.
It is. And management explicitly said this strength gives them flexibility. Flexibility for, more share repurchases if they choose, but also to actively look at M&A.
Acquisitions. They mentioned that.
Yes, they said they continue to view M&A as a strategic priority and are actively engaged in conversations.
Interesting. Let's quickly touch on the income statement components, net interest income and non-interest income and expense.
Sure. Net interest income was pretty stable compared to Q4, but it was lower than Q1 last year.
Why the year-over-year drop?
Mainly lower average earning assets. That reduced interest income, although higher yields on the assets they do have partially offset that.
Interest expense.
That decreased, which helped stabilize NII sequentially. That was driven by lower levels of interest-bearing deposits and that lower overall cost of funds we talked about.
Okay. And non-interest items?
Non-interest income increased. That included the $2.2 million gain on the OREO sale, plus higher income from some CRA-related equity investments.
And expenses.
Non-interest expense was up slightly from Q4, but pretty comparable to Q1 last year if you back out some prior FDIC special assessments. They did mention increased investment in technology as a factor there.
How did that all shake out for efficiency?
The efficiency ratio improved slightly, came in at 46.7%, still very efficient.
Okay, so wrapping up the call itself, what was the overall tone from management? What's their outlook?
Generally optimistic, I'd say, particularly regarding loan growth potential in commercial real estate. They pointed to those strong April closings as sort of proof of concept.
So they expect production to pick up?
Yes. They said they expect loan production to start outpacing payoffs in the coming quarters. They also highlighted the strong core deposit growth, especially from new relationships in that specialty banking group.
And their underwriting approach.
They emphasized continued discipline there, regardless of the economic backdrop. Sticking to their knitting, essentially.
Yeah, and the M&A angle. Any more color there?
Just that they remain active in looking at deals. And interestingly, they mentioned the recent large merger announcement in their market. They see that as potentially advantageous for CVB, maybe creating opportunities.
Right. Potential disruption creates openings. Okay, fascinating stuff. Let's shift gears now to our This Is Not Financial Advice segment. Time for some outrageous but plausible trade ideas based on what we just unpacked.
All right, let's brainstorm. Idea number one. Given CVB's strong capital, that consistent profitability we talked about, and their explicit interest in M&A,
Yeah.
You could, hypothetically, consider a long position in CVB Financial itself, ticker CVBF, and maybe pair that with short positions in a basket of, say, smaller, publicly traded California banks.
What was I thinking there?
The thesis is that CVB, with its stability and acquisition appetite, might outperform, while smaller peers could either become targets, facing integration risks, or just generally navigate more uncertainty in a consolidating market. CVB could be a relative winner.
Interesting. Playing the consolidation angle from both sides, but purely speculative, of course.
Absolutely. Not advice, just an idea floating out there.
Okay, here's another one. Maybe focus more on their operations. They reported that uptick in CRE originations, average yield 6.5%, and management sounded pretty positive about CRE momentum. So another not financial advice idea. Maybe look at going long companies that service the commercial real estate sector, specifically in Southern California. Things like specialized material suppliers or property service firms.
Based on what?
Based on the premise that CVB's increased lending activity, given their strong regional presence, might be a sort of leading indicator, suggesting potentially increased activity and demand within that local SoCal CRE market itself.
So using CVB's lending as a proxy for broader regional CRE health.
Exactly. Again, totally hypothetical, not a recommendation. Just connecting some dots from the call.
Both definitely thought-provoking scenarios, drawing directly on the call's details.
All right, that wraps up our deep dive into CVB Financial Core, Q1 2025 earnings call. We've hit the key results, management's view, and even spun out a couple of what-if scenarios.
Covered a lot of ground.
So what stood out most to you from this? What questions does it leave you with? As always, we strongly encourage you to do your own thorough research. Join us next time on TalkTickers for another detailed look inside an earnings call. And remember,
this is not financial advice. Any investment decisions you make should involve careful consideration and, ideally, the advice of a qualified financial professional.